Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it. Kia ora koutou and welcome to the 18th episode.
19.
Oh no.
19.
Make that 19th episode of Markets, Mystics and Mayhem. This week we're going to talk about inflation expectations. It's really important for a central bank because as inflation rises, expectations rise, that becomes self-fulfilling. We don't like that. As inflation falls, expectations fall, and, we can see whether we've won the battle on inflation. And then we're going to just see where we go, I think, with the conversation today. But to kick things off, I'm going to ask MJ, what is inflation expectations and what have they done?
Yeah, big question because, first of all, I guess the survey of inflation expectations, it's the Reserve Bank survey, and it asks forecasters and business leaders where they think inflation will be across various time horizons, going from 1 year ahead to 10 years ahead. And we've seen a bit of movement in that space right across the time horizons, just given what we've seen in terms of inflation. We really saw for example, the 1 year ahead measure really rise when inflation was at its highest. It's all come back down. Similarly, looking longer out, it was kind of becoming unanchored from the 2% target for a while, but again, it's kind of coming back to target.
And why is unanchored a concern?
This inflation expectation survey, it's kind of like a credibility check for the Reserve Bank. How much do these forecasters, business leaders actually are convinced that the Reserve Bank will be able to, meet their price stability mandate? And to get that kind of check, you need to see inflation expectations at that 2% target. And again, it's been moving around, but now it's kind of come back.
Yeah, I don't think the Reserve Bank minds too much about the 1 year expectation going over. It's all about, are they going to meet their mandate, which is 2%. And when you have people saying no, you're not, it's like, oh geez, we need to really hike or cut to get that back to 2%. And I think there is a stroke of genius in central banks giving us a number. Because when they tell you a number, it's in the back of your mind. So as an analyst, over the medium term, we do tend to just go, well, inflation's going to be at 2%. Otherwise, the Reserve Bank's not doing their job. And we don't think that's the case. We think the Reserve Bank will do whatever it takes to get inflation back to 2. So our medium term guesstimations for inflation pretty much anchored on that 2% that we've been told, ingrained, brainwashed by the central bank. But it's important for when it does deviate.
Yeah, and I think where the rubber really hits the road is beyond the mandate. It's that, as you sort of said in the intro, that inflation expectations actually do have an impact on actual inflation. So we know that businesses and households, they make decisions, expecting not just what inflation is tomorrow, but what it's going to be a year out, 2 years out. And so depending on where they think inflation is going to be, if they think inflation is going to be higher in 2 years, then obviously that's going to go into their costing decisions. If you're a worker and you think inflation is going to be higher in 2 years, you're also going to be thinking, or in 1 year, you're going to be thinking, okay, I need to demand more in my wage salary review. So it actually does have that self-reinforcing effect, which is sort of adds to where it really comes down to the Reserve Bank's credibility. Because once you have those expectations unanchored from that 2%, that's where their job gets a whole lot harder, doesn't it?
Yeah, absolutely. I mean, there's a lot of industries, workers out there whose pay is linked to inflation or wage measures. So come pay time, the negotiation generally starts with this is the actual inflation rate we want, above or below that. So it is behavioural. It really does become self reinforcing.
Yeah, because as you say, it's when they expect it to be 2%, they'll act as if it is 2% in 2 years' time, and that just becomes and then you start to see prices go higher or costs go higher, and that just gets passed on to consumer prices. So it is a really important measure for the Reserve Bank.
Yeah, and so what are we saying? So inflation expectations have moved south in the last survey. They all dropped, the 2-year, 5-year, 10-year, they all dropped closer to 2%. So from the Reserve Bank's perspective, credibility, massive tick, and job done, massive tick. That they've tamed the inflation beast and people believe them. So price stability is forecast.
Yeah, and it's been that way, I think, for the last couple of surveys. It's been kind of bouncing around that 2% target. So yes, it could be a couple basis points higher than 2% exactly. But you could say, I think, with confidence that inflation expectations are well anchored and well contained.
So if they're anchored,
then more rate cuts. Here we go. But what I was going to say was, even though, as you were saying, there's a bit of movement throughout the tenors or the year ahead measures, even the 1 year that lifted 10 basis points and kind of bucked the trend of all the measures moving lower, again, not really too much of a worry. Why are we seeing that? Well, the New Zealand dollar weakness has been a big player there. So obviously a bit more fears about imported inflation. Then you've also got the Trumpflation fears and the higher petrol prices at the moment. But even then, at 2.15%, still pretty much 2%.
Yeah, and I mean, we hear comments online, we hear comments from clients, the Kiwi dollar's fallen, petrol prices might rise, there's a whole lot of tariffs coming through from Trump, and, that's all inflationary. And it's like, but that's a temporary shock. And if your inflation expectations are anchored medium to long term, then from a central bank's perspective, you can have a bit of volatility in the near term. That 1 year rate, who cares? Because everyone's expecting it to go back to 2. So, my take from the inflation expectation survey is job done, firstly, and the Reserve Bank will, I think, hand on heart go, this is great. Expectations are anchored. So why are we mucking around on interest rates? Why are we talking about pausing at 3.5% when quite clearly I think the economy needs a more neutral setting, which is 3%, and that's what I think the Reserve Bank will ultimately have to deliver. Once again, they'll come kicking and screaming late to the party, but they'll get there.
Yeah. I think that's been our call for a long time, actually, hasn't it? Saying that we need to get back to neutral. Markets pricing that in now as well, a cash rate of 3% by year end. And then actually we can kind of start to see the end of this cycle. And actually markets are pricing in hikes into 2026, which is interesting. That's just the way cycles go. We've gone through a cutting cycle, and then once the economy stabilizes and actually gets a bit of growth, maybe it's time to actually consider going the other way.
I would love to call for rate hikes.
Yeah.
Absolutely love to call for rate hikes. People have been looking at us going, you've been on the dovish side, you've been calling for rate cuts. Yes, there's been a recession, bad one. Since 2022, we've had a per capita recession that snowballed into 2024. We've got rising unemployment, and we've had, dozens of companies really struggling. It's time to snap ourselves out of this recession, and that requires rate cuts. It doesn't require mucking around. We have been on the dovish side, but I am actually thinking very seriously that we should be considering rate hikes in 2026 and beyond, because I think if they deliver what we think they should deliver, which is rate cuts, swiftly down to 3%, then we will be talking about a strong recovery into 2026, and one where they can start, hiking again. If it's late 26 or early 27, doesn't matter. The next move being a rate hike would be, really important and really good. And it also means that we can come up with a clever title for 2026. Like we got the whole alive till 25. Now we're talking thrive in 25. If we're right, we might actually see some rate hikes in 26. Then it can be. 6 in 26.
Yeah.
Come on, that's gold.
I think it's quite funny to look back to sort of when I first started here at Kiwibank, and when inflation was running quite high, up in the 6, 7s. And we were actually getting asked quite a lot by media and just in general, whether the central bank, the New Zealand Reserve Bank sort of inflation targeting was too low and actually needed to be moved from, 1 to 3% to higher. And I think, our answer coming back to inflation expectations was always that, maybe that's a story for in the future, but right now, their credibility actually hinged on them being able to return inflation back to 2%. Or their 1 to 3% band, because as you say, once and we've seen this in history, once you move up that target band, your expectations immediately go with it. So if the central bank were to change their target from 1 to 3% to say 2 to 3, immediately in your head, and for businesses and households, inflation is now between 2 and 3, never between 1 again, because that's what they're targeting. But yeah.
Yeah, absolutely right. There was a period there, inflation was running at 7.3. People were saying, why don't they lift their target? Well, actually, no, that's precisely what not to do. From a credibility perspective, you've got to fight the good fight. You've got to get it back to 2%. And then when it's at 2%, like it is now, we can have a discussion about how they handle some of these inflationary forces that are coming through, whether it's on the back of climate change related costs and inflation there, or whether it's other longer term issues that we face. We can have that discussion next year, because they have got inflation back to where it is. Credibility check. Let's have that discussion maybe next year and beyond. And it's a discussion we have to have.
Because, I think if they had changed the target band back then when inflation was still running hot, kind of just been throwing throwing in the towel at that point, I think. But I do think that it is a valid, case to look into, because the domestic inflation that we're seeing now is quite hot. It's coming down, but it's hot for reasons that seem a bit more structural. Council rates are strong. Insurance premiums are still high. They're running at levels where you'd think that we had a natural disaster happen a quarter before. So it's still running quite hot, and I think that's more of a structural issue. It's not going to be easily, fall away. So I think there's a valid case to rethink the target bands.
Well, we did have a cyclone, so there has.
But that was a couple of years ago.
True.
And
and then there's Wellington.
True.
Then there's Wellington, who didn't have a cyclone, but they're just suffering from decades of underinvestment, like the rest
on
of
the
country.
Council stuff. The insurance premiums are reacting to it, and insurance premiums globally are going up, which means that our reinsurance costs are going up. That's about a third of Kiwis' insurance premiums. So insurance premiums are what you say they're up. They're up 25% and 28% for contents insurance. I mean, that's just amazing. So if we're saying 25, 28, there are areas like Wellington and some other areas that are getting much higher rates, and some that are getting lower. So that's got nothing to do with monetary policy. That is climate change adjustment, and like you say, councils have underinvested for decades, so there's massive catch up there, and that I think councils are running at like 15% over the year. That's not a one-off.
No,
that's not going back down. People need to realise that's not going back down. If anything, it's going to rise another 15-20%. They've just got so much money to spend on stuff that they should have been doing decades ago.
Yeah.
But if you visit Wellington and you like watching beautiful fountains, water fountains spouting up everywhere, it really is quite magic. It's unintended though. It's their pipes bursting.
Yeah. So in considering, I guess, the target bands, playing devil's advocate for raising the band or widening it, is that there's an offsetting factor being this technology, kind of, what do you call it, the Amazon effect of how globalization can really put downward pressure on prices. That's what we saw with imported prices pre-COVID being in the negative, so deflationary coming from offshore. And I think we did see it rise during COVID because shipping routes were closed and all that, but we have kind of seen it gone back to deflationary territory, which could be, just a continuation of that.
Yeah, I mean, there's some really exciting developments on the technology side. I mean, my God, AI is mind blowing in what it can potentially do, and I think most of it's productivity enhancing and potentially reducing costs of a lot of things. So, and mainly in services. So, yeah, AI technology could bring a massive wave of deflation. So yeah, that could be a bit of an offset to what we're talking about. So central banks need to take all of that into control, into consideration. Sorry, and tweaking with the bands. I don't think they like doing it, but there could be a CPI basket that we get that excludes some of the climate related stuff, rather than lifting a target band, which kind of is throwing the towel in a little bit.
It's risky business, right?
Yeah,
you do risk those inflations becoming unanchored. So
yeah, it is. Like you say, you increase your target, everyone's expectation, because
just move up.
I've just said, we all know 2% is the number. Change that to 2.5 or 3, and then just ticks up in our minds.
Okay, but I think I kind of disagree that we're going to get more disinflationary impacts from offshore, because we do have technology advancing and AI is going to be great, but we know New Zealand is quite a technology laggard in its sort of adoption of new tech. And then on the other hand of things, we talk about globalization, but I think we are entering this period of potential deglobalization with more trade, not maybe trade wars as such, but maybe but closer or tighter trade policies between countries. So I think there is risk, which maybe I'm just not a devil's advocate and I'm leaning towards the other way.
No, I think it's fair though, because I think you'll be hard pressed to find any research that shows that productivity is not deflationary or has that kind of potential. But the question is, are we are we going to strengthen our productivity in the next longer term? And as we heard from a Reserve Bank speech on productivity, we are kind of miles away from strengthening it and keeping sustainable growth through enhanced productivity. So we are in a more inflationary world, I think, in the medium term.
Well, thanks for killing the mood. I thought we had an answer there. I thought AI was going to save us all. Well, we can argue both sides of that, and I think we all will be over coming years. Okay, well, on that note, I think we are done. Inflation expectations, really important for central banks to be on top of it, and fantastic to see our inflation expectations survey returning to 2, exactly where the Reserve Bank wants to see it, and means that they can cut without fear of spiking inflation down the track. So we take this as a very positive survey and enabling the central bank to cut to where we think they need to go, which is 3%. So thank you very much for tuning in. Please like, please subscribe, please get involved and give us any insights you think that we should cover, and we'll speak to you again next week. You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.